VERTEX Pharmaceuticals has dropped its Q1 2026 earnings, and this is not just another biotech update. Behind the numbers is a company quietly executing one of the most powerful multi-franchise pivots in the industry. Strong cash flows, near-perfect execution, and a future that looks very different from its past. Here's what investors need to know. To understand the full picture, we are going straight into the engine room to analyze Vertex's balance sheet, valuations, core revenue streams, and the risk-reward matrix. Let's start by looking at the bottom line from Q1. Vertex delivered a massive Q1 revenue of $2.99 billion, marking an 8.2% year-over-year increase driven by core cystic fibrosis demand and new commercial ramps. Non-GAAP net income came in at $1.15 billion, while non-GAAP diluted EPS hit $4.47, leading management to firmly reiterate their full-year guidance of $12.95 to $13.1 billion.
Looking closely at margin efficiency, total revenue expanded to $2.986 billion, keeping Vertex on track to generate over $500 million from non-cystic fibrosis products this year. Non-GAAP operating margins stood flat at an elite 44%, while GAAP net income spiked nearly 60% to $1.03 billion, normalizing after a large non-recurring asset impairment charge suppressed earnings last year. To bridge the gap between their 38% GAAP operating margin and 44% non-GAAP operating margin, we look at stock-based compensation, which added $166.4 million. Crucially, this stock-based compensation is virtually flat year-over-year, demonstrating exceptional overhead discipline across the entire company. In their core franchise, total cystic fibrosis net revenue reached $2.915 billion, accounting for over 97% of total revenue. While Trikafta revenue dipped 7.1% to $2.355 billion, this is actually product cannibalization by design, as patients rapidly transition to their newer regimen, ALYFTREK, which surged to $424.4 million. Beyond cystic fibrosis, Vertex is successfully validating its new growth pillars. Casgevy, their sickle cell and beta thalassemia gene therapy, brought in $42.9 million, up 3 times from last year. Meanwhile, JOURNAVX for acute pain generated $29 million, showing rapid market penetration across both hospital and retail settings. Geographically, execution is incredibly well balanced across the board. United States revenue hit $1.78 billion, driven by robust pediatric demand for ALYFTREK and initial commercial rollouts. Outside the US, revenue expanded 9.1% to $1.21 billion, fueled by favorable foreign exchange tailwinds and reimbursement approvals across 11 nations in Q1 alone. This entire commercial operation is backed by an absolute balance sheet fortress. Vertex holds $13 billion in cash, equivalents, and marketable securities, up $700 million sequentially. They have 0 long-term debt obligations, meaning their operating cash flows entirely self-fund their expanding R&D pipeline, capital expenditures, and share buybacks.
Looking at shareholder returns, Vertex has reduced its diluted share count from 259.5 million down to 256.3 million shares year-over-year. Transitioning from a single therapeutic cash cow to a diversified biotech platform creates a multi-pillared growth model, structurally justifying a valuation premium relative to its peers. The bull case relies on 3 massive upcoming catalysts. First, povetacicept for IgA nephropathy showed an incredible negative 52% change in kidney protein levels during Phase 3 interim data. Second, key pediatric expansions are underway to deepen their cystic fibrosis moat. And third, the No Pain Act is providing a major commercial tailwind for hospital adoption of JOURNAVX.
On the flip side, there are 2 headwinds to keep an eye on. First, pipeline concentration gaps exist, as several promising correctors remain in early Phase 1 trials. Second, Casgevy execution is highly complex as an ex vivo gene therapy, meaning regional onboarding delays could create volatile or lumpy revenue quarter to quarter. A quick financial health audit reveals exceptionally clean metrics. Stock-based compensation is not growing faster than revenue, net income is tightly aligned with cash flow as total cash balances grew by $700 million, and accounting adjustments are completely standard, proving their elite 44% operating margin is highly sustainable. In synthesis, VERTEX is successfully executing its transition into a multi-franchise biotech powerhouse. Their premium valuation is structurally supported by 4 distinct pillars: cystic fibrosis, sickle cell, acute pain, and nephrology. This allows them to fully fund a massive pipeline while consistently returning capital to shareholders. If you found this VERTEX Pharma earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.